Hello and welcome to the interview with me, Aisha Faridi. 6 months ago on this very show, Jim Walker told us that the US was heading into recession, AI was missing the letter R, and that gold's rally hadn't even begun. And India was at the fast start of a 5-year bull run. Since then, tariffs have bitten, the Fed has kept cutting, gold has kept climbing, and the AI trade has only gotten bigger and more controversial. Dr. Jim Walker is now also Global Economic Advisor to Equirus, deepening his India coverage. Chief Economist, Alethea Capital, and the man who called 2008 before almost anyone else. Dr. Jim Walker, welcome back to the interview. Thank you so much for your time today.
Thank you. Good to be here.
Right. Jim, I recall our February chat, and you were calling for a US recession within 6 months. We're well past that window now. What is your takeaway on recession in the US? And do you still stand by that call, or has the timeline simply moved now?
Well, we've actually only got to the second quarter data for the US. And if you look carefully at that data, the US GDP number for the second quarter year on year was 2.1%. That's one of the lowest growth rates in the last basically the last 5-6 years since COVID. But the problem is really that it's all in one sector. It's all about the big ramp up in capital expenditure, which is of course related to AI, as you just mentioned. And if you strip that out, what you find is that the US investment cycle is negative, and basically the economy is hanging on by its fingertips. So I think when we get into the third and fourth quarters, and especially as the AI spending has to slow because there's no electricity to allow it to continue, then we're going to see significant slowdown in the US economy.
Jim, talking about AI, you also said that AI was missing the letter R for returns. 9 months on, CapEx has only accelerated to some mind-boggling numbers. Has anything you've seen changed your mind, or are we closer to the reckoning that you warned about?
Well, you know, the whole point, Aisha, is that the R is, as you say, returns. Returns in the long term. Of course, in the short term, people can fantasize about returns because there's no returns at all just now on the AI that's coming through. The cash flow from it into the companies that are putting in massive amounts of capital expenditure is minuscule in comparison to the actual capital expenditure. But my point really is that when you look much further out into maybe the next 5 years, never mind all the hyperscalers in the US and the large tech companies. You've got China coming up in the inside track with all of its AI companies. And then we're going to see AI spread across the world in different parts of the world. Different companies are investigating and researching and building AI models. And all I was really trying to say is that AI is going to be ubiquitous over the next few years. There will be no return at all on it. It will be as cheap as air. That's the nature of a non-economic good when everybody can produce it. You think about it in your own computer, that if you go and ask an AI a question saying, can you build me an AI model? The answer is yes, and it can do it for you. You can have your own AI system.
Yes, it's fascinating what all it can do. But I also recall, Jim, that gold was a highest conviction call back in February. Your allocation was up to about, I think, 20%. It's been a very strong run since, with a few past months of good consolidation as well. Do you stick with that number today for allocation, or have you raised it further?
No, well, I haven't raised it further. I think it's still a pretty kind of strong number. And yes, we stick with that conviction on gold. And the more that I'm afraid US finances, and I'm not talking about the AI boom here, I'm talking about the government finances, become the center of attention, and that is going to increase and increase and increase, then the more attractive gold is. I think you would probably be looking at the dollar index at the moment, which is down almost 10% from its high in the last 2 to 3 months. I think it goes a lot lower from here. It's currently around about 97, 98. The DXY we would expect by the end of the year to be trading around 90 as people begin to lose even more faith in the US dollar and the way that the government is run. And while that happens, then I think gold naturally goes significantly higher from here.
Your India call, Jim, was a 5-year upcycle led by financials and capex. Has the market's performance, especially from the March low since the break off, or rather the peak of the West Asia crisis, has the market performance since that validated it? And is the trade still as clean when it comes to India?
Well, I mean, I'm still very positive about India looking out over the next 5, 10 years. The problem, of course, is the amount of short-term noise that's going on around the world, partly to do with AI, but an awful lot to do with the war in Iran. And of course, people are still concerned about commodity supplies, fertilizer prices, and various other elements that feed into emerging market nervousness much more than they do into developed country nervousness. So I'm glad that the market has consolidated. Would I say I was slightly disappointed in terms of the overall performance? I think yes, given that India continues to be a broadly based economic growth story with capital expenditure powering ahead, the credit growth numbers in India looking very, very solid, the inflation numbers in India remaining tamed, and therefore giving the RBI scope to at least hold the interest rate steady. All of the conditions for India to have an absolutely fantastic bull market are there over the next 5 to 10 years in particular. So I'm very happy with our recommendation. I'm very happy with my own positioning in India. It's just that I would quite like to see some of the short-term noise disappear so that people could concentrate on fundamentals again.
Talking about fundamentals, now that you've taken on a more formal advisory role with Equitas as well and spending more time in India's provinces, what has that ground level access changed about your India thesis, if anything?
Well, ground level access is always really important to me. That's been I suppose, the trademark of Asianomics over the course of the last 20 years when I was at CLSA and then into the Asianomics and Alethea phases. We really concentrate on speaking to people, trying to listen to what they've got to say, not just central bankers and government ministers, but academics across countries and journalists, basically people who are in touch with what is reality. That, to my mind, is the only way that you can do economics and come out with a sensible answer. Looking at the data only and then trying to formalise it into economic models, I think, is an incredible waste of time and resources. So we're really just at the starting point of broadening the contact points in India. That will continue. Nothing I've seen so far. Obviously, India is a very disparate country. There's tremendous differences between provinces and states. Same as China. That always is tricky to try and aggregate. But I think the general movement of India, and of course some states lead, other states lag, but the general movement of the government towards a much more clear, ease of doing business model, I think is just going to take India significantly higher in terms of its economic growth trajectory and therefore in terms of the return on capital and the returns to equity investors.
So when will we see the meaningful FII and FPI money come back into India equities, Jim?
Yeah, it's a good question. They're very fickle investors. They tend to follow, I'm afraid, momentum much more than they do fundamentals. And that's been the case for, I suppose, really the last almost 20 years since the the global financial crisis. The whole of the market community has become captured by government policy and central bank policy. And with that, it's very much captured by the commentary that comes out of these people as well. That's a real pity because they create nothing and they produce nothing for the real economy. But everybody listens to them and everybody tends to make market moves and market allocations on the back of what they think central banks will do and what governments will say. This is a very, very bad model that we've been in for quite some time now. It will fail dramatically over the course of the next few years. I think we're already beginning to see the cracks in America because they can't get their fiscal position under control. And that is now leading to a divergence between central bank interest rates and market interest rates, especially at the 10-year level. That's only going to grow. Further good news for gold. But it takes time for people to realise that they've bet the wrong story. And the wrong story is to think that central banks can continue with what they've done over the last 20 years. And that's just flood the system with money. The bond markets are telling us that that game is over. The bond markets are saying governments have got to get their act together. And when that happens, emerging markets, which, believe it or not, look much, much better in terms of debt positions, and I would say even now inflation positions, than a lot of the industrialised countries. Emerging markets will come back into favour, and I think India will be one of the top names when that happens.
I also recall you had said that bond markets were disconnecting from central banks back in February, which was a rare signal. Is that disconnect still there? And what is it telling you now that it wasn't back in February?
No, it's telling me exactly the same thing. The disconnect is still there. US 10-year treasuries have gone higher than they are at the moment, but they're now drifting back upwards again, currently around about 4.6% on the US 10-year Treasury. The Fed funds rate, on the other hand, has, since its first cut, come down 170 basis points, whereas the 10-year Treasury in the US, from that cut, has gone up 60 basis points. So, you know, you're talking about a 230 basis point swing, divergence, if you like, between these interest rates. That's very, very, very unusual. And I would say extremely concerning for the government in the US and indeed for bond markets generally. So I think the warning signs are still there. These warning signs obviously take time to penetrate people's thinking, but penetrate they will eventually. And with that will come a very different phase in investing in the global economy.
Interesting. China, and you just touched upon that as well, Jim, was your other long call, right, on domestic stimulus and a services pivot. Has Beijing delivered on that story? Or is the case now perhaps weaker than when you had made it?
Yeah, it's been interesting, actually, and I must admit, not quite obvious to me that the government in China has done an awful lot less than I would have anticipated in terms of trying to stimulate the domestic economy and specifically the services sector. They're working away kind of quietly in the background, but if anything, in the first half of this year, China has tightened fiscal policy. Now, a lot of that has to do with various things that are going on outside China, and it's watching what's happening in the Middle East, etc., etc. And at the same time, continuing to do exceptionally well in export markets, and therefore the GDP numbers continue to do pretty strongly from the export contribution. But it has surprised me at how, I wouldn't say reluctant, but how much they've stood back from the domestic economy and just allowed things to continue to unfold there. It tends to be a mark of confidence that the that everything eventually is going to be all right when governments are doing that. The one thing that you would expect is that if they were really, really worried about the domestic economy, they would be panicking and definitely doing something on the fiscal side, if not the monetary side as well. And that's just not happening. So it is a wee bit of a puzzle. They seem to be quite, well, not confident, but quite comfortable with the idea that 4.5% to 5% growth in China, which is what they're heading for at the moment, is perfectly okay. So it's a very different approach from the Chinese government in comparison with a lot of other governments around the world.
Jim, I recall, Feb, we were talking about tariffs and then came the West Asia war. Will geopolitics for the next foreseeable future continue to dictate economics?
Well, that's the concern. I'm not at all convinced that the Iranian situation has actually improved very much. I don't know where Washington stands as regards the whole story now. It changes from one day to the next, if not 1 hour to the next. That confuses people. It keeps people on the sidelines when that kind of behaviour is ongoing at a political level. So I fear that we've still got quite a long way to run with the effects of the war in the Middle East and the closure of the Straits of Hormuz to a certain extent. I think that's still out playing out. Remember, there were a lot of strategic reserves in position in places like China, parts of Southeast Asia, Japan, the United States, that have covered for the decline in supply from the Arab states and Iran itself. That can't last forever. And I think we're into the second half of the year now, and things will become, I fear, a lot more tight and perhaps discordant as we go through the next few months.
So, Jim, you've spent your career warning against groupthink, 2008 being the obvious proof point. What is the consensus view today that you think the market has got completely wrong?
I continue to think that the concentration on AI is very naive in terms of the way that this whole, I'm afraid, bubble has been built. There's an awful lot of off-balance sheet financing going on to try and push capital expenditure to absolute limits in the United States and elsewhere. I mean, we see it in the European economies as well, and increasingly some parts of Asia, where data centers are being built and data center applications are going in, but there's absolutely no guarantees that there's electricity there to provide for those data centers once they're built. Not only electricity, water supplies. You've probably been aware that in Europe this year, the summer has been exceptionally hot. They keep saying since records began, but of course records actually only began in 1860, which is a blink of an eye. There have been periods over history where it's been much hotter and rivers have run much drier in Europe than is the case just now. But if we're moving into a period of climate change where it's going to be hotter in Europe and rivers are going to be much drier, the one thing that, again, people tend to forget about AI is that it's not just electricity hungry, it's incredibly water hungry as a coolant. And as populations rise, the UK is at 70 million people now, but investment in those facilities and indeed in water management and water reservoirs and storage has not kept pace with the increase in population and the increase in demands from things like AI in the data centers, then we're going to run into a brick wall in these countries. And I really do think that will have a big impact on people's perceptions of the high-tech investments, including semiconductor chips, at some point. But it's not there yet, obviously.
Yeah, I guess, and that's the whole debate about. So, Jim, If you had to rank your four February calls, that's short the US, long gold, long India, long China, by how much conviction you have left in each of these calls today, and what would be the pecking order?
I tend to be usually putting long gold at the top of that list at the moment, purely because of what's going on with the dollar and with the federal government and the US public debt and the like. That really is the big driver of gold prices over the next decade, and that's just not going to change. Then I would be India, then China. These would be my three big calls just now. The AI one, which I continue to be very skeptical about, I just have no clue how long it's going to take people to realise the mistakes there.
Interesting. So if Jim Walker had to allocate $100 across asset classes, across geographies, what's the breakup going to be like?
Well, I can tell you what my breakup is like just now. As you said, I've got quite a big chunk in gold. I'm not quite sure that I've got as much as 20% myself in it, but in emerging markets, I'm well over 50% of my portfolio in emerging markets. Gold would certainly be about 15% on top of that. And then it's a case of a few bits and pieces here and there. I've got investments in uranium and nuclear power. That's partly to do with AI, but I think that's the main power source that will be able to at least respond to the demands from it. And I've got quite a fair amount in blockchain, which is my proxy for Bitcoin and cryptocurrencies, because even though they tend to be very volatile, they're not going away, and the underlying technology has lots more applications. So that's an insight to my own portfolio just now.
So final word, Jim, what's the one number, data point or signal you're watching most closely right now that could perhaps force you to change your mind on any of these calls?
I'm not sure that would change my mind, but the country to be watching out for just now is Japan. You're seeing the US Treasury Secretary getting very involved in trying to reduce the depreciation in the yen, try to stabilize that. There's reasons for that, and part of the reasons are that the more the yen depreciates, the higher the inflation impulse in Japan. And the higher the inflation impulse in Japan, the more likely that the Bank of Japan is going to be forced to raise interest rates much faster than people are anticipating. That's the one thing that America cannot stand. Because if interest rates start to rise in Japan, the carry trade unwinds. And when that unwinds, the demand for US treasuries disappears. A lot of the demand for AI investments in the US equity market disappears, and a lot of money goes flooding back into Japan before the appreciation in the currency wipes out their overseas capital gains. So if you want to watch a country at the moment that is really a fulcrum point for the world economy, it's Japan.
Interesting. And always so good chatting with you. Never short on conviction, Jim Walker. Rarely short on controversy. From a US recession call, or for that matter, on your call on gold, or for that matter, India as well. Always great and insightful speaking with you. Thank you so much for your time.
Sure.